Welcome back to the black hole of real estate. And today I want to take some time to talk about investment properties. And maybe, just maybe, it's your first investment. And you're thinking, what are the steps that I should be taking, especially in the current market environment? What's my return on investment going to look like? And what are the risks? And ultimately, should I stay or should I go? Should I do it now? Should I wait? Yeah, so the first thing about investment properties, understanding what you want it to do. And there's two paths. There's one for monthly cash flow. And so if you're a cash investor, you're going to have some math equations going to tell you if it's a good deal or not. An old school rule of thumb would be for every $100,000 that you spend, you want $1,000 coming back in rent. And that works okay at 100, and even at 200 to get to 2,000 it starts to fail, and by 300,000 you're not likely to get 3,000 in rent. So it's a measurement that you can use, and it works until it doesn't. Now the next thing that you might consider is, well, you know what if we had, instead of 1% rolled, maybe 0.8%. So now on 200,000 could I get 1,600 of rent? That might be likely. But where's the rest coming from? Well, again, if you're a cash investor, maybe it's on upwards lift and appreciation. Maybe the property's going up 3 to 5% per year. So that might be something that you look at. Now the other side is, what if you just broke even, but you were buying something that you felt was undervalued or in an area that was going to take off? Let's say that you were buying something, and let's say that 10 years ago you knew the Space Coast was going to take off because there was going to be this bunch of rocket launches and trips to the moon. Maybe you could have bought in Titusville or the Space Coast area, Cape Canaveral, years ago at a super low rate. And then, if you had that crystal ball, maybe you would have done that. And what if you broke even on the property on the rent, but 10 years down the road, long term, there was a really good lift that you could use to either continue to leverage an opportunity for more growth or sell it off at a profit. So there's that forward thinking piece where, as long as I break even, I just want to control the asset because I do believe it's going up in value. And of course, Nirvana is making a lot of money every month and the property going up in value. And there was a lot of that going on over the last few years, in all honesty, because the values have risen dramatically in the last 5 years, as have rents. So unfortunately, the time to do it is, you kind of look over your shoulder. Yep, 2013 would have been a really good time to do that 10 years ago, and some people did. So what do you do now? You're looking at your first investment property. Let's take it from that perspective. The landscape of what to buy feels inflated because prices have gone up. But is it an inflated price or is it the going rate? Let's call it the going rate. And let's imagine for a moment you're going to spend $250,000 on a property, and you've looked at taxes and insurance and your mortgage rates, which have been creeping up. Maybe you're in for, I don't know, $1,800, $2,000 a month, something. Maybe that's where you are. And if you're going to manage it yourself, you've probably got a situation where you could at least break even. Maybe you make a little bit of money. If you're hiring a property manager and you pay them, take that off your plate so you can continue to work at your job or something like that. That might eat into it. And you're thinking, well, geez, now I'm losing money. What if I'm losing $100 a month when it's all said and done? We've got it rented. It's a good tenant. We're paying a property manager. All we do is collect checks from the property management company. But we're losing $100 a month. Well, you are, but are you? You see, there's this thing in your mortgage called an amortization table. And this is the hidden savings account. And let's just suppose for a moment that you bought this investment property for $250 and you put 20% down, which a lot of investor deals are right now. $200,000 mortgage. Every month, that $200,000 balance goes down. So maybe you are, losing $100 a month. But what if you're retiring $300, $400, $500 a month off the principal balance in the beginning and more over time? So if you look at your amortization table and you add that back in, if you will, maybe you're losing $100 in the transaction of paying the mortgage and collecting the rent. But what if you're getting the power of paying down $200, $300, $400 a month? Because that's real money too. And that negative $100 a month might actually be positive 2 or 3 or maybe even $500 a month depending on the terms of the mortgage. So there is that piece that allows you to make money over time, because when you eventually sell it, someone's been paying for that mortgage for many, many years for you. It's a lot like a 401k or a hidden savings account where it just automatically splits off into an account that you never touch. Because people do that with their paychecks. They take most of it in their account, and maybe they send a little bit into a savings account, $100 a check or a couple $100, and it just kind of goes there for that rainy day fund. That's how we lock up equity in homes that we can't touch, and it comes back to help over time. There's another thing that goes unnoticed. Let's suppose that you're working W-2 and you've had a good year and you paid some taxes in, and you're looking for a refund. What write-off might you get? When you have an investment property, many CPAs recommend depreciating that asset. And taking some of that depreciation over time also helps at tax time. And what if that saved you, I don't know, $2,500? Well, it's another $200 a month. You divide that 2,500 by 12 months, so a little over 200. And all of a sudden, maybe you're losing $100 a month on the mortgage transaction because you're getting rent, paying a property manager, and you put that in your account and you write the mortgage check, and you throw $100 into the kitty. Okay, and it's paid. But what if you were getting a few $100 off the mortgage balance and a couple $100 a month on depreciation that's coming off your taxes? Tax you don't pay to the government that you never get back. So you get to keep that. Let me repeat that. Tax you never pay to the government, and you also get to keep that. So that's good. And all of a sudden, that negative investment might actually be making some money. So when you're appearing on the landscape, well, what should I do? When should I do it? The time to buy is when you're ready. And what I've witnessed is that across market conditions, we think we're trying to time the market, and we think we're tricky and smart. But the person that got in last year when rates were higher, they were getting to 5%, and everybody's going, wow, they're 5% now. The people that delayed buying to this year, and now they're 6 or 7 or whatever they're going to be. Last year's deal is looking pretty good, even though it felt expensive at the time, because since the last year has occurred, property values have gone up a little bit, rents have gone up a little bit, but rates have gone up a lot of it. So there was money even buying last year. My suspicion is there'll be money buying this year. There just will be. And it won't always be in the form of higher interest rates making it more expensive next year. It could just be the fact that property values cost more next year, or rents have gone up more next year. It might only be the first year where you're missing that $100. Maybe the second year or the third year, the rents have gone up high enough because you got a fixed rate mortgage. Rents are increasing. That'll balance itself out in a year or two, if it even takes that long. But with the benefit of depreciation and amortizing off the mortgage and paying down the balance, those are just extra things that are really, really good. So I wouldn't necessarily delay my entry into the market. I'd really look at this as a long-term wealth building strategy. Nobody in their 20s really peered down the road to see that little bit coming out of their paycheck into the 401k every month. They got used to missing that money because they just look at the net paycheck and what was going there. After a while, you don't notice it because you've been living off the remainder. And that's a situation with this. So I would encourage anybody who's maybe delaying a purchase because prices are high or rates are high. Those things are temporary. And quite honestly, many mortgage companies right now, if you're financing, are putting in price guarantees, so they'll refinance you and waive the lending fees. I've got to believe there's some lending fees, and there may be recording fees is a better word for that, when you do a refinance on the mortgage perhaps. But the lenders are waiving, in many cases, 3 to 5 years down the road. If rates go down, they'll automatically give you a refinance. No questions asked, just do it. So there would be relief down the road, and that would create an even bigger disparity between what the cost of mortgage is and the rent, and then put extra money in your pocket. So delaying today could quite possibly cost you a lot of money down the road because you're not in the game of investing in real estate. And typically, for those that get into it, it might take a year or 2 or 3 to get the first one, and the second one comes along, might take a little bit, and the third one. By about the fourth one, it becomes one a year and a couple a year, and it really takes on a life of its own. With 401ks and pensions and Social Security being, let's just say, at a crossroads. We don't know what that looks like 10, 20, 30 years down the road. These wealth building strategies through real estate are going to help a lot of forward thinkers prepare for the life ahead, whether it's retirement or early retirement, and travel, and having a source of income, revenue for themselves and their family down the road because they had the forward thinking to have a wealth building strategy in place. So if you are someone who is on the fence about making an investment, maybe your first investment or your second investment, I want to just let you take a peek behind the curtain and see what the strategists are thinking and the savvy investors are. They're not so worried about, am I making 100 or 200 bucks a month right now? What else is there on the horizon for this, and what are the mechanisms that would allow these to be good investments when on the surface someone's passing on that investment saying, oh, it won't cash flow. Cash flow is only one small piece of the equation. Now, it's an important one. It absolutely is. But it's just one piece. So now you can stack it and rack it. The 1% rule. Am I getting $1,000 back in rent for every 100,000? Maybe, maybe not. Could you get 0.8 or some number like that and get some upwards lift on increased value? Absolutely. Are you amortizing a mortgage where somebody's paying the mortgage off and you're getting the benefit of several $100s a month coming off the principal balance? Because that's money that you never don't have to pay back. And what about depreciation? You see that factors in your taxes as well. So there's absolutely a way to cash flow a property if you look at the whole puzzle and not just the one piece. I hope that helps you as you continue to be thoughtful and make a really good decision for yourself about investing in real estate. And if you have questions, well, absolutely leave us a comment below. Give us a like and subscribe to this. We're here to help with your real estate investment needs. This is Ron Wysakarski for the Black Hole of Real Estate.